Good evening, everybody. Welcome out. We're going to give it a standard 1 or 2 minutes. Then we're going to get going. All right. Okay. Hello, Perry. Good to see you. Hi, Bob. Got a good crew here. Good to see everybody tonight. We are close. If you're anxious for options, we're almost there. We have tonight, Thursday. Then next week, we kind of do our wrap up. Thursday next week will just be like a, you know, open Q&A forum, anything we want to discuss. So, yeah, we're close. Then when we switch to options, remember that we have 16 options sessions this time rather than only 8. So I'm excited for that. I hope you are. We're on the tail end of the trading foundations. We are finishing here with record keeping and analytics. Hugely important. Hugely important. This part of the foundation, without the record keeping and the analytics, you are driving blind. Imagine you're on a road, driving, it's a straight road, perfectly straight. There's a ditch on either side. You're just driving along, everything's fine, and all of a sudden somebody pops up from back seat, puts their hands over your eyes. It's a straight road. Come on. All you got to do is go straight, which is no problem as long as you have what? Feedback. We need feedback, right? If I can't see, I don't have feedback. Now, someone might be able to be like, turn left, turn right, turn left. Well, there's some feedback, but me seeing it myself, that's the best feedback, right? And that's, think about that. How many people trade like they're driving with someone in the back seat covering their eyes? They just don't have the data. How are you making decisions as to what you should keep doing, what you should change, what's working, what's not? If you don't have data, I don't understand what basis you have to make decisions with your trading, especially when it comes to trying to improve it. So that's what we're talking about. It's giving ourselves that data story. This is a business. You wouldn't run a business and not keep records. You wouldn't just guess at how much you pay for your items and how much you pay for your marketing and advertising and your utilities and your employees and all that, and how much you said. I mean, you got to know, does this make sense? What can I do better to make more money? What can I do worse? Or not, what can I do worse? What can I stop doing? Sorry. What can I do better? What can I stop doing that's hurting me? It's the only way we're going to make these decisions. This is critical. If you're trading without record keeping, here's the bottom line, and then we're going to dive into it. If you're trading without a solid structure for record keeping with automated analytics, if you're trading without those things, it's a hobby, period. That's it. And it may be hard to hear, but if you're trading without doing those things, you are trading for a hobby. So don't be surprised. And it can be a very expensive one. And it can be expensive, not just financially, but emotionally, right? Trading can take you hard places, dark places. So don't do it unless you have everything in place. That's the whole reason we call this foundations. Pour the cement. What's in the cement? If your foundation doesn't have record keeping, you're building your house on sand. So I guess we'll live with the results. So let's talk about the record keeping. What does it need to be, so that this is not a hobby, that this is a business, that I have expectations and I can create projections, and I understand what does it look like when it's successful, so I can understand what's going on if it's not. Changes everything, I can tell you that. Here's the disclaimers, as always. You love them, you know them, they're in your emails. Here's our agenda today. Intro to record keeping. What types of trading records do you need to maintain? How do you maintain effective records? What do you need to include in those records? How can you prepare those records to be processed for analytics? What are common mistakes that are made? How can we avoid them? And what are the next key steps and the takeaways? So bear with me here. And actually, give me 1 second. I think I need to add one thing here. Bear with me. I'm going to get a second. I think I'm trying to combine this. Analytics. Yes. Okay. Sorry. There we go. Okay. Let's get going. Intro to record keeping. I forgot that this was a double, so I'm actually going to go fast. We're going to talk about record keeping and analytics today. I was going to combine my slides. I forgot to combine them, but we're going to still stick to the agenda. What is the importance of record keeping? Keep your questions coming, comments, questions, throw them at me so that if we run out of time at the end, it's okay because we've already addressed your question. And let's go. Record keeping importance. It's the cornerstone of disciplined trading. This is the start of the discipline that you're, I know for a fact, Bob has changed his cadence. When he pulls the trigger and a trade fills, he logs the, actually, I think he logs the trade when he places it. And if it fills, he keeps it. And if it doesn't, he gets rid of it. He has a great cadence to make sure that every single trade gets logged. I'm envious. I make sure I try to do it. I try to do it when I take the trade, but I don't let it get past the weekend. That's my set of rules. Make a good faith attempt to log the trade real time. And I'll tell you, having real-time feedback, having real-time analytical feedback helps, because sometimes when I'm going to book a loss, or if I'm going to take a loss, but it's going to be a small one, I love putting that trade in, because the second I put it in, it's going to immediately lower the size of an average losing trade. Awesome. That's one of my core jobs. Keep my losses small. If I'm working at any given time with an average of $200 loss and I book $100 loss, yeah, that's a victory. Pat yourself on the back. Job well done. Trade went wrong. You kept your loss to half of your average. That's going to bring your average down. Some people struggle with the concept of losing better. They just think, oh, you're like losing. No, you have to learn to lose better to be a successful trader. So this is how we do it. And record keeping can help us to get that discipline. You monitor your performance, you learn from past mistakes, you maintain a consistent approach to trading. Remember that our objective here is to standardize every element of what we do, because when something's going wrong, we need to pinpoint what aspect of our plan is contributing to that, and then we fix it. It's an engineering process. We don't guess at it. This is very much a specific process. The impact on trading success: well-maintained records empower data-driven decisions. If it's not based on data, it's based on emotion. It's that, again, today's the session where the rubber meets the road, where we really say, look, it is our core philosophy. A lot of this is based on our core philosophy, but this is a matter of saying, stop kidding yourself into like, God, I don't know why I'm not making money. Of course you do. You don't have record keeping. You now know. That's why, because you have no mechanism to help you make real decisions. It's emotional if it's not based on data. You're just, I feel like I should do this. My trick knee tells me I should do that. A talking head on CNBC said this. If it's a hobby, that's where you are. If it's a business, that's not good enough. We need data to tell us what needs to change. It helps us to identify and correct mistakes, adapt to changing market conditions, and refine our strategies over time. God, I mean, come on, right? That bullet alone should be enough for you to be like, hell yes, record keeping, let's go. Effective record keeping distinguishes successful traders who learn and grow. Again, the concept of record keeping and analytics, the entire concept of a trading plan that could be 10, 12 more pages. Successful traders do what failing traders don't want to. It's that simple. I lose people all the time because what I'm selling sounds a little bit like work. And it is. It's not hard work, it's work. You got to be diligent. You've got to be committed. You've got to be disciplined. You got to do the work. It's not like you're doing 100 hours of work. It's not like you're toiling laboriously, right? And straining ourselves, but we have to be willing to do the work. This is part of that work. All right, let's go. Bob says, I need it because I might forget the source if I don't. Absolutely. Too many moving parts to just think we're going to keep track of it in our head. What kinds of records do we want? Trade execution records, very important. The details, entry, exit, stock, symbol, trade, strategy, source of the trade, as Bob said, right? These are all the execution records. We want to make sure that we're encompassing risk management records. So do we put where our stop loss was? Do we put where our position size was? That's more, I used to do that a lot more than I do now. I found that I wasn't actually getting a lot of information from that after a period of time. Initially I did. I got a lot of information from it and I made some adjustments, but then I'm like, I think I've made all the adjustments that are going to help. So some of this, you may not do all the time. Psychological records. What emotions did you experience? Did you lose discipline and why? The sooner we can write it down and hold ourselves to account and actually come up with a conclusive reason as to why it happened, the better off we're going to be and the faster we're going to progress. Market research and analysis notes. This is one that not many people do. You do not find, but we keep track of our market posture. Because if I look back 4 months and I say, wow, I had a great November. Or if I look back 5 months and I say, man, I really struggled in October and I want to go back and learn from it and figure out what went wrong and what can I do better. I can't just look at my trades. That's not enough information. Right? Okay, so what about your trades? I need to know the context that those trades existed in. I need to know, what did I think the market was doing versus what did the market actually do? Because that might be fundamentally my problem. If I'm bad at reading the market, I'm going to have a hard time trading. So I need to make sure that if I go back and I say, oh, well, look, I was bullish and the market was bearish. Well, you just found yourself a problem and you need to fix it. Or if the market was bullish and you keep trying to take puts, like, what am I doing? Why do I keep buying puts? The market was bullish. What am I doing here? Right? We need to know, right? We need to know. And we need to have the context in order to make those types of evaluations. Lastly, broker statements and tax documents, keeping track of your records, especially for short-term gains. It'll make your life a lot easier for taxes if you have good records. So this is business records here. If you don't have all of this, what do we have? Probably a hobby. And you might have hobby records. I know people who do hobbies who keep records, but they're not like really learn to do better records, right? Okay, moving on if I can. Where was I? There we go. How to maintain effective records, tools and software. There are software that's available. I believe in spreadsheets and just, basic, I want it to be digital. I want to be able to save it. Particularly, I want my record keeping to be in a spreadsheet because then the data can be automatic. But we talked about here's another one for records: goals, keeping records of goals. What have you tried to do in the past to get better? How did it work? What did you learn from it? You could keep that in a spreadsheet. You could keep that on a Word document. Doesn't matter. What's comfortable for you? Data, is it a specialized trading journal? Is it some kind of cloud-based storage solution? Find what works for you. Keep it all in one place if possible. Learn strategies for categorizing and structuring your records. I know people who take pictures of every trade on the day they enter and the day they exit, just a screenshot. And they have a little template that they put a little bit of information in, and every trade they take, they have a little folder. They can go back and find out, here's what it looked like, here's what I did. That's a lot. That's hard. I don't know that I could maintain that for a long period. Maybe if you did that for 3 months because you're trying to learn. We don't have to do the same thing all the time, but you gotta, really try to hit it hard in the beginning and then get to a place where you say, this is what I'm comfortable maintaining. It has to be enough. Honestly, it has to be at least the spreadsheet that I provide. That's the minimum. That's the minimum you need so that you have enough data to categorize and sort, and that it is automatically generating your trading results. That's what we're looking for. And think about data security and backup considerations, right? Be careful. Right? We're really not exposed. We don't have like our password saved or anything like that, but still, always good to be careful, especially with something cloud-based. What do you want to include in your records? Trade date, time, instrument, entry, exit, position size, risk management, trade rationale and strategy. What were you doing? We want to put in the journal where there's the emotional state, the trade discipline notes. Did you lose discipline? Why? Anything that you might need or think might be helpful analyzing this trade in 2 months when you're going to forget exactly what happened 2 months from now. And you want to say to yourself, ooh, yeah, I was nervous about the Fed, so I shut it down, blah, blah, whatever it is, put it down. You're looking to just give you the more data points you have, the more likely you are to find patterns in your data. Patterns in your data are going to help us to say, that's a good pattern. Let's make sure we keep doing that. Let's formalize that rule. Or we say, that's a bad pattern of data. That's not working. Let's get rid of it or adapt it. But we don't just keep doing it, right? Just bounding our head into a wall. Let's adapt. Be water, my friends. Preparing for analytics. I jumped ahead of my own slide. Identifying patterns and trends. We're using records to spot recurring patterns in our performance. So capitalize on strengths, address weaknesses. It helps us to actually see those strengths and weaknesses. When people just look at like, oh, am I making money or losing money? That's just not enough, right? That's really just not enough for us to actually do anything differently or better. It's got to be on a trade by trade basis. We've got to see the data completely. Anything less than that, once again, if what I'm saying, you're like, I don't know, there comes a time when people decide, hey, you know what, trading's not for me. And I would rather have somebody lose less money because they're managing their risk well until they get to the point where they say, this isn't going to work for me. I don't want someone to blow up an account. I've seen it, obviously, way more times than I want to remember, where they lose 50 grand and then they're like, it's not for me. Well, God, man, 50 grand. We could have lost 10 grand, drawn down 20%, walked away and said, I made a run. I learned something about myself. You're not going to be happy that you lost, right? But if we don't have all of this in place, I have to wonder where the expectations of success are coming from. We want to make sure that we're improving our decision making based on numbers. Trading is a numbers game. That's it. It's a numbers game. That's what we're boiling it down to, and it becomes an engineering process. So you need to know your numbers. If we know our numbers, we can start to learn from what we've done in order to become more consistent, more successful going forward. Common mistakes: incomplete or inconsistent data entry. It'll drive you crazy because you'll look at your trade. Let me pull it up. You'll look at your trade. Oh, where is it? journal, or excuse me, your trade log. Let me grab the trade log. Where is it? Trade log. Option log. Okay. You'll come here and you'll say, oh, I'm looking at trades 1 through 25, but it'll only count 22 trades. And you'll look at your trade log and it looks like everything's, but that means that all the data is not in place. Remember that on this page, everything is automated. As long as you fill out the record keeping and everything that we said you need to do is in here, the dashboard will fill this in for you so that you're getting real-time feedback that you can use to assess, am I keeping my losses at the level they're supposed to? Am I getting if I think I'm getting into trades at 2 to 1 or better, is my reward to risk at 2 to 1 or better? Because if I think I'm getting 2 to 1 and my actual reward to risk is 1 to 1, then there's a huge disconnect between my expectations and what I'm actually producing. Great, let's figure it out. At least we have something, at least we have a clue. We have a lead to explore in this mystery we're solving. And that's what we're looking for. Any kind of lead we can that helps us to find those marginal improvements that we can make. Okay, let me drop back out of this. So make sure that you have a standardized system where you use the predefined template. You have a routine to enter all data immediately after execution. Disorganized record keeping. Yeah, I've had people that keep notebooks. And I'm like, what are you going to do with a notebook? You're going to flip through the pages, get your calculator out, run it a few times, have an error, have no idea where that error is. That's a terrible idea, right? Use good naming conventions, put dates in there. Just, overkill is fine. Keep a trading file folder on your desktop where you can just kind of get in there and create a file structure system of where you keep logs and trading plans and old trading plans. And yeah, I absolutely think I don't have the quote on here, but there's a very interesting quote that says, show me a good record keeper and I'll show you a good trader. The person who said that is a guy who has written 4 books based off of interviews he's had with the most successful traders of the last 50 years. Market Wizards is the name of the books. Phenomenal stuff. Neglecting regular reviews and analysis. You should schedule it. Right now, I would say monthly. Eventually, it'll become quarterly and then maybe even semi-annually. But make sure that you have in your trading routines specifically scheduled periods of review where you look at your record keeping, you assess your discipline in actually keeping the records. You go through the numbers, you figure out what you can learn from it. Super important. Okay, so key takeaways. I feel like I'm on a good pace today. Key takeaways. Effective record keeping. It's the bedrock of disciplined trading. You want to be disciplined, right? There's no switch for discipline. There's just activities that we can do that help to promote a higher level of discipline. Discipline is the professor. Discipline, logic, right? Rational, mindful, deliberate. That's the professor. What's the opposite of that? The chimp. The chimp is a frenzy of emotion and panic and fear and elation, imbalance. Yeah, right? Keep the chimp in the cage. Data-driven decision making. That's it. If you're not making a decision based on numbers, ask yourself, why am I doing this? What's motivating me here? Put a sentence behind it that says, I am making this change to my rules because. If you don't have a good answer that's based on data, why are you making it? Don't do it. Figure out the database decision. Self-reflection, continuous improvement. It helps us to identify patterns of strength. Keep doing it, build from it. Patterns of weakness, eliminate them, mitigate them, whatever the case may be. Be aware of common record-keeping mistakes and implement strategies to maintain accurate, organized records. It's that simple. I don't think I can say it any better. Without the record keeping, just enjoy your hobby and understand. There was a guy one time, a famous trader, and he said he was being interviewed. I don't know if it was a full press conference, but there was multiple journalists, and he said, "You get what you want out of trading." And a person stopped and said, "Well, what does that say? What does that say about someone who's losing money in trading?" He said, "You get what you want out of trading." Well, a person might want the euphoria of speculation. That's what they're after. They're not looking to put time in and make it feel like a business. They want it to feel like they're in Las Vegas, and they get what they want from it. If you want consistent success, to get what you've never got, you've got to do what you've never done. Get going on that. Start record keeping. Begin it, improve it immediately. Make sure it's all encompassing with what we've talked about here, and the templates we've given you are pretty much getting you to the place you need to be in the beginning. Schedule your routine of reviews so that you're actually assessing yourself, that you're actually looking for patterns, that you're now that you're taking the time to give yourself the record keeping, make sure that you're benefiting from the lessons that will be learned from that regular review and implement continued improvement over and over and over again. Okay, I'm going to stop here. I'm going to pull this out. I didn't combine my presentations, but I am be water, my friends. Move right into it. We're moving straight into part 2 of today's presentation, which is analytics. The power of numbers. They're like magic. Mathemagic. Categories of analytics. What numbers are we trying to understand? What does it mean to us? What are the types of analytics? We'll take a look at the spreadsheet. To the spreadsheet, Batman. We'll go look at the spreadsheet a little bit more. Make sure that you're comfortable with that. It's a great starting point if you don't have anything else in place. If you have something that gives you that information, great. I'm not going to encourage you to change it. We want to make sure we understand common mistakes. We want to understand best practices. Bam. Let's get into it. Part 2. Informed decision-making. The analytics let you have insights derived from data, period. Those are data-driven decisions are professor decisions. Anything else is a chimp decision. How's that to phrase it for you? Anything that you're deciding to do that's not backed by data, that's the chimp. You just invited the chimp to the keyboard and said, "Hey, you want to make some trading decisions, my friend?" Nope, I don't want the chimp making any trading decisions. Thank you. Risk mitigation. This is going to allow us to see how well we are managing risk and assessing risk and learning to have a better understanding to manage the uncertainties and to minimize losses going forward. So when we have those situations where a loss all of a sudden is bigger than we expected, we're like, oh, how do I learn from that and make sure that doesn't happen again? Right? We specifically look for those outliers where we didn't contain our risk as the first place I want to do a post-mortem analysis on a trade to say what happened. That's what one of the things we're talking about next week is a post-trade analysis. If you don't have a routine for post-trade analysis, how are you learning from your past trades? And if you're not learning from your past trades, why? There's so much information there for you to improve from, but we've got to have a systematic approach to make sure that we actually glean that information. Okay, lastly, performance optimization. Obviously, we're trying to increase the size of our average win. We're trying to decrease the size of an average loss. We're trying to improve our win rate. And we would accept any one of those three. Because if we get any one of those three without sacrificing one of the other two, our expectancy, and that's what we're measuring for on the spreadsheet. That's what you should be measuring for. We don't measure for quote unquote profit. That's built into expectancy, right? Expectancy is how much do we expect to profit for every dollar we put at risk as a ratio that is tied to our risk amounts. That's what we need because that's a standardized number. Now we can make better decisions with that standardization in place. That's what's going to help us get consistent, improved performance in the ever-evolving trading landscape. Categories of analytics. What are some of the different ways that you can process it? So we process automatically the first one and the third one. The second one, it can be, and here's what I mean by that. Well, actually, I'll get to that. Let me talk about these three, and I think, well, yeah, let me get to that. So cumulative means I have 100 trades. How did those 100 trades do? By time frame means how did I do in March versus April, April versus May? If you're trading 25 times a week, then you're looking at week 1 versus week 2, week 2 versus week 3. 25 is my number. That's what's built into a set of data in the spreadsheet. Every 25 trades. So that's the by number. For me, it's by 25. By time frame, it depends on how long it takes you. So it's typically going to be one or the other, but we definitely want to have at least 25 in place. By system or strategy. So we can isolate and say, hey, I have 3 different systems that I trade. I have my own discretionary trades. I have a newsletter number 1 that I subscribe to and newsletter number 2 that I subscribe to. So when I log a trade, I'm going to make sure that I categorize. Where did this trade come from? And after I get a certain number of trades, I'm going to say, you know what, let's isolate and let's look at newsletter number 1. We can see how many times is it right? And how many times is it wrong? How much does it make when it's right? And how much does it lose when it's wrong? What's the reward to right? All the things that I'm about to show you for the types of analytics. And then we can compare it to newsletter number 2. And then we can compare it to us. I expect you to be the highest performer. I expect you only to trade other systems that can provably maintain a positive expectancy. If its expectancy drops below 0, what are you doing? You're at a slot machine now. You're at a slot machine and no one's coming to bring you a free drink. So there you go. Negative expectancy. You have just turned into a gambler. That's not a trader. Traders, the difference between a gambler and a trader is a positive expectancy. Gamblers have negative expectancies. Traders have positive expectancies. So have I worked with gamblers who are in the market? Yes, and my job is to turn them into traders because there's a big difference between gamblers and traders. One of the first things is this record keeping. Sorted on the system column makes it easy. That's exactly right. So we can sort by system, by strategy. We can sort by trade type, right? If you want to say, hey, do I do better with calls or bull call spreads? Calls or naked puts? Do I do better buying calls or buying stock? We have to be able to isolate it, and then we can measure it. If it's first step in this process is standardize everything. If it's not standardized, you can't measure it. If it's standardized, we can measure it. If it's measurable, it's improvable. You can't get to improvable and skip a step. You can't just be like, hey, let's go make this better. Make what better? What are you making better? Your random decisions of how to trade? You're going to make those random decisions better by what? Making them differently random? They're random to begin with. You're not going to improve random. That's the point. Okay. Types of analytics. This is what I need. I need to know how many trades I took. I need to know how many of them went right and how many of them went wrong. I then need to know what my winning percentage was and what my losing percentage was. I need to understand when I'm right, on average, how much do I make? I need to understand when I'm wrong, on average, how much do I lose? I need to know the combination of those two to get my reward to risk ratio. I need to take the reward to risk ratio combined with the percent winners and the percent losers to get the expectancy. That's the first big bottom line. expectancy, right? That is if it's positive, I'm a trader, I'm successful, I have a reason to expect to be successful in the market. I'm going to try to continue improving it, but that's the first place we want to get is a positive expectancy. Kelly criterion with that little asterisk next to it. What is that? That is risk optimization. If you get your expectancy to a point where it's positive with a minimum of 50 trades at that level, 100's better, 50 minimum, then we have the ability to look at our risk levels relative to the risk capacity. How much risk can a system sustain mathematically? Oftentimes, it's actually higher than the risk level that you're taking. So what that does is give you the ability to try to steadily increase your risk. You're making more money for exactly the same activity, right? So that's what Kelly criterion is all about, is risk optimization. You can't optimize risk if you haven't done all this in the first place. We need that expectancy, period. Once we get to that point, everything means a little bit more. Okay, to the spreadsheet, Batman. To the spreadsheet. So once again, what are we doing here? All you got to do is come into the log. What symbol is it? What system? What type of a trade? This is an option log. So if I did a call, bull call spread, bear call spread, bull put spread, butterfly, calendar, whatever it is, long or short, super important on both the stock and the option that you get this right. If you bought it, you're long. If you sold to open, sold a naked put, that's a short trade. If you sold an iron condor, that's a naked put, or excuse me, that's a short trade, naked put. Anything, if you're in the stock trade, if you buy it, you're long. If you sell to open, that's shorting the stock, long, short. The spreadsheet can only work if you get this column D correct. Very important. What date, what price, how many contracts? The rest of this is pretty self-explanatory. If you ever don't know, it has some information up top. And then anything here in gray, number of days, is automated, automated, automated. These two are automated. Once you fill out the log, now on this, everything is automated except for these two. You can put in how much equity you have, and you can put in your trade risk. Now, what this is going to do is it's going to automate every variable we just talked about, from number of trades through Kelly. It's also going to give you net gains, net losses, net profit loss. It's going to give you what your trade risk percent and risk per trade is. It will give you a loss to risk ratio. It'll tell you how long you stay in winning trades. It'll tell you how long you stay in losing trades. It'll tell you how long you stay in winning trades after taking the first profit. Net return, it will give you the beginning date and the end date, so that if you look at, let's say you look at trades 51 through 75, and you say, wow, that was terrible, I need to learn from it. Well, you go to your beginning date and your end date. You know what period of time you need to look at the market to understand what you thought the market was doing at that time, what the market actually did at that time. Then you can go to your trade log and you can find these dates and these trades and start learning from them individually. I tell you right now, you will learn more from yourself than you ever do from me. When you dive in and you create a structure that allows you to actually dissect in a learning fashion your trades, your learning will take off in a way that you never could have expected, because you're learning from experience. This isn't book learning. This isn't theoretical learning. This is practical application learning. You're doing it. You're making adjustments. It's real time. We've got to have that component in what it is that we're doing. So that's what we're doing with record keeping and analytics. They're part and parcel. They're tied together. The routines we can't do one without the other. So a few things before we wrap up. Common mistakes. Overlooking the component of risk management. The mistake is not prioritizing in our analytical analysis. So we don't recognize, I have too many trades that are hitting max loss. I have too many trades that are bigger than if I think my trade risk amount is 500 and I'm having trades that are losing 6 or 7, I need to see that immediately so that I can make adjustments. The impact is we have inadequate risk assessment will lead to jeopardizing capital, hindering long-term success. Chasing trends without validation. right? If we're following the market without validation, you're like, oh, I'm feeling bullish. Well, if you're bullish, you better, as you're making bullish trades, you better see that your results are there. Otherwise, we need to make sure that we reassess the premise that we're coming on. Over reliance on historical performance. Yeah, look, we want to make sure that we understand what we did, make adjustments going forward, and apply the adjustments to current market conditions. Obviously, market watching is what we do. What are the best practices? Data gathering. We need to have a thorough collection of data that encompasses trends. That's our market posture log. Economic indicators. Actually, I'm going to say I don't really keep track of what it was. I really rely on my market posture for that. But the market posture, the trade log, that includes the journal component, a journal or some kind of a record keeping structure for your goals. It might sound like a lot, but I'll tell you what, when you get it right, you'll know why. Continuous validation and testing. Make sure that whatever theory you have, you construct it in a way that you can test it and see the numbers and say, hey, you know what? If I do X, this is what the result will be. My losers will get smaller. Great. Then on the next 25 trades, do X. What should you expect? You should expect your average losses to decrease. Now, if they do, is that a victory? Not necessarily. Because if our average loss decreases and our average gain decreases, well, then it's not necessarily good. We need to make sure that as our average loss decreases, our reward to risk ratio increases. That's when we had a net positive impact. So we're never just looking at one variable, right? In our validation and our testing. And we want to make sure that we employ a diversified set of analytical approaches. Try to find the light. Once in a while, you can show me the light in the strangest of places if you look at it right. Perspective is everything. It's everything. You might not know that you're bad at options until you isolate options compared to stock. You might not know that you're better at spread trades than you are buying options, or that you're better trading bullishly than bearishly, or that you're better than the newsletter service that you're subscribing to. They're actually breaking even while you're making money. So stop paying for them and focus on your own trading. How do you know those things if you don't have the analytical tools that help you to actually find those patterns? Key takeaways. Do it. Do it. Start keeping records and analyzing so that you can make data-driven decisions, right? If it's not numbers based, again, you really got to question what the basis is for that decision. Make sure that risk management is the cornerstone of everything that we do. Protect the king, right? Always remember that. Protect the king. If you never lose, it's a lot easier to win. Adaptability through continuous analysis. This is a ongoing real-time process. That's why we try to record and update the log immediately after execution or by the end of the week. I'm gonna give you that. I definitely struggle to maintain the daily cadence, but I will make sure that I do not get past the end of the week without my record keeping being up to date. Strategic diversification for success. This is the only thing that allows us to understand, what does that look like? How do I change my approach so that I'm not just throwing spaghetti at the wall and hoping something sticks? It's a very deliberate process. When we have this detail and this granular level of analysis, we have the ability to see things that we wouldn't otherwise be able to see. And that's the point. Nobody ever takes the time that I've worked with in the last 20 years, well over 10,000 traders in the last. I've never had a person come back to me after I've had them sit down and Again, I'm assuming that you're a serious trader, or at least you want to be a serious trader. Never had somebody say, you know what, Scott, I don't know why you had me write this trading plan. I don't know why you're having me keep these records. It is fundamentally self-evident almost immediately as you see the information that you start to have access to. There's no other way to do it. I still struggle to see somebody create an argument that says, you know what, you don't need to do that, Scott. Really? What are you doing instead? And how is it providing you information that you can demonstrably say this is going to make me a better trader? That's it. If it's not, then we should question it. And what I do is I tell people, question me every step of the way. You should challenge it. Why are you doing it this way? This should be very deliberate. It should be very purposeful, right? We shouldn't have any ambiguity. If someone says, why are you doing that? We should have a very specific explanation, what role it plays and what information it generates, or what decision it might inform. Next steps, get your trading log up to date. I've had people go back and do entire years. They go back and they're like, I'm going to put 2023 into a log. And again, they never did it. And they're like, you know what, Scott, I did that. It just, it didn't make any sense. It didn't help. Never one time was the results they got not more than commensurate with the work they put in, period. It gives you information you can't get any other way that is specific to you and your trading. Make sure you're integrating robust risk management. Make sure you're committed to continuous learning. You know what? This is our process, and I hope that we always get more and more people coming in. We're going to lose people. They're going to say, yeah, you know, it's too much for me. It's too much work. It's too much. They're hoping someone's going to, hand them some trades, and there's no longevity in that. You'll bounce around from system to system, but if you're really looking to make this something where you significantly improve your time frame to build your account to a certain point, and then at a certain point, right? You know, if you're able to show that you can get 15 to 18% annual returns, how much faster can you turn 100,000 into $1 million? And if you can get to $1 million, what does 15 to 18% give you on an annual basis? That's 150 to 180 grand right there, right? There are people retiring with $1 million who put it in an annuity and get 40 grand a year. And they're like, what? That's all I get? I save $1 million and it pays me 40 grand a year until I die. That's the end of yeah, right? So what I will say is it's worth it to have this. This is I think that this component, if you're serious about it, makes it so that this could become a regular purpose or a regular routine in your life. Honestly, when I look at the time frame can be hobby time frame, but it's got to be business commitment, right? We don't have to spend more than 8 to 10 hours a week doing this, but you've got to do it with the right routines, the right structures and organization and everything else in place. Okay, that's it. That is it. Next week is not intro to options. We're not doing intro to options this time because we're jumping straight into options in 2 weeks from tonight. Next week we are doing I'm not even quite sure. I'm not sure, but it'll be something good. I put record keeping in analytics, and then I put analytics. So I might give myself a freebie to do something fun with. We'll see. Post trade assessments. Yes. But that was okay. So I have an extra day in here that I'm going to get to do something with. Maybe I will do an intro to options. I'm going to give myself an extra week to think about it. So yeah, Thursday, we're going to do post trade assessments. Next Tuesday and next Thursday, we're going to have a Q&A wrap up, but there will be one more session. I'm not sure what I'm going to do with it, but it'll be good. Any questions about today? I mean, look here, let's do this. If you don't know where to go to get started, remember that every email, even tonight I'll send you an email that'll have this recording. And in that, you're going to have links. Those links are going to take you to these places here. There's a link to this welcome doc. So when you go to your welcome doc and you say, I want to see the current watch list. It's right here. I want to look at the historical market posture. I want to put that into mine so that I can have that record. I want to have my trading plan outline. That's here. I want an option log. That's here. Any form you need to download or any site you need to access because we use it. So you can see we have a FinViz search parameters. We have major market analysis and sector rotation for our market posture. We have Yahoo Finance, economic calendar, the interest rate tool. These are all things that we use on the day-to-day. So anything you need to start getting working on anything is going to be in here. That's the welcome doc. Then you also have the content library. I'm going to reorganize the content library. I don't like that these 1 minute snippets are at the top. These are just little 1 minute videos that are like, oh, that was fun. But you have your trading plan videos, each section of the trading plan. You have your market posture videos, each component of our market posture. Here is the trading foundations that we've just gone through. All of that is here. This was our first pass at options. You can see there's only 8. This second time, I'm going to have a new set of links and we'll have 16 options sessions. So anything you need to focus on any individual component of the trading plan, any individual component of the routines that we build, it is all here with a library of videos to help you go through each specific component. That's it. Let's get started, right? So here is, remember that this week we're actually working on improvement strategies. We just finished our first pass at the trading plan in 2024. 8 sections. We're 8 weeks into the new year. We just had our first pass. Next week, we're going to come back up here and we're going to do it again. Some of you, it might be your first time and you're just trying to get it, just define something. Put a sentence or 2 down. On your second pass, you're going to try to refine it a little bit more. And on the third pass, you're really going to try to polish that plan. 6 months, 3 passes, a trading plan you would have thought you had if you do it diligently 1 hour a week, especially if you're doing that simultaneously to keeping your records. So again, ready to make the commitment, ready to move your trading from hobby trading to business trading? This is the path. Follow me. Otherwise, hey, we're about to start the alerts. I think we can help you. The alerts will be helpful. But if you're not doing it completely, if you're not fully committed, then you shouldn't wonder why you're not hitting that level of success that you're really looking for. All right, that's going to do it for me. We're meeting tomorrow morning. Don't forget, we had no Monday, so we met this morning for our market open. And already tomorrow we are on our midweek review. What's happened? We got a VIX hedge, but we also have a bit of a doji today. The buyers came back in a little bit. We did not have above average volume. So we're in a little bit of a precarious place, and the next couple of days should inform us. Didn't have a lot of trades that I was carrying, able to close them and actually still keep profits. I've got my hedge on. If it drops, I'm okay. If it holds up, I'll take my hedge off and I'll look to find some bullish trades out of the, we had plenty of signals today, right? Plenty of signals. All right. It's good to see everybody. Join me tomorrow morning, 9:15 a.m. Eastern, 15 minutes before the market opens. Oh yeah, that Capital One ran for you, Bob. That was a great trade. That thing really kept running all day long. Gap down and ran all day. Love it. Have a great rest of your night, everybody. I'll see you in the morning. And as always, happy trading.